Hello and welcome to another Dolphin Financial Radio Show with me, Dan Wendell, owner of the Dolphin Financial Group. Today's topic is going to be risk aversion in retirement. Now, risk aversion is avoiding risk or not liking risk, and that seems to be the case for many retirees. But I want to talk specifically about this behavioral concept of risk aversion and how it can sometimes be very irrational. For instance, you might be offered a bet or a outcome that's going to be favorable, yet you just don't take it, which is not rational for a lot of people, but a lot of people do it anyway. And so to help me illustrate this and talk about this, I'm going to bring in my trusty sidekick because he acts very irrational. I know he is risk averse. There he is. Tony, welcome to the show. How you doing today, Tony?
Risk averse. I am risk averse to some extent anyway. I'm doing great. Thanks for having me on the show, Dan. This is going to be a great show. You know how I know that?
Because I got dice behind me?
Yeah, because of your background image. It's very cool. Roll the bones, as I like to say.
Yeah, so I'm going to give you some scenarios. I was going to use a coin flip. So I was going to put a coin behind me, but I said, let's roll the dice instead with this.
Oh,
this
I
image.
like that. Yeah, I like that. Coin flip, just a coin behind you. That wouldn't work. That doesn't.
Yeah. So, Tony.
Yes.
I want to talk about risk aversion.
Okay.
Okay. And I want to relate it to retirement because this is a retirement show. But before we get into how it relates to retirement, I want to offer you some options. I'm going to give you some scenarios.
Okay.
That have to do with gambling. Well, yeah, it's a gamble a little bit if you think about it. Yeah, it's I want to see if you are capable. I want you to be honest, and be as open as you can about this.
I always am.
Don't think about what the lesson is. I'm not trying to hit you on the head with one here. Let's make it fun like we're in a casino. What do you say?
Oh, casino? I love that. Oh, yeah.
Nice.
Yeah.
All right. So now you're in the mood.
I'm going to hit it big. Oh, listen to that. It's paying out. I love that. The big payout. There we go.
Yeah,
there we go.
That.
All right.
That's for those that have been in casinos. That's one of the annoying sounds. Actually, it brings out the worst in some people.
Oh, I'll be honest, Dan. I am not a fan of casinos and gambling.
Yes, we did a show, you and I, in Vegas together, literally in Vegas.
That's
and
true. We were both in Vegas, and neither one of us are big Vegas guys. That's for sure.
I mean, I like to go there, but I'm not a big gambler per se. I do like playing poker, but
I like playing blackjack, but not gambling. So I just
play it by yourself in front of a mirror.
Well,
okay.
Yeah, I don't know how that works, but
this is not real money, but I want you to try and pretend it. And listeners, I want you guys to answer the question in your heads as well. How would you go about answering this? And if you don't like the way Tony is responding, be sure to comment about it so I can pick on it.
Oh, yeah. Please.
So here's the first scenario.
Not Tony. Liking me. I love how you demand they do that.
Scenario number 1, Tony. I'm going to flip a coin. Okay. If it's heads, you win $101.
Okay.
If it's tails, you lose $100.
So you've got a coin with two tails on tails on.
No, okay. I knew you were going to say that. It's a standard coin that it's not a trick coin. It's one they would use at an NFL game to decide who kicks off.
Okay. Why don't you let me choose heads or tails?
Okay, whatever.
And if I guess right,
if you guess correct, you win 100. If you guess incorrect, you lose 100. You win $101 or you lose 100. Would you take that bet?
Oh, so if I'm wrong, I have to pay you?
You pay 100. If you're right, I pay you 101.
No, I wouldn't take that bet because I don't want to lose $100.
Okay, I knew you would say that. All right. So,
You did?
yes.
Well, you were
Scenario.
hoping. What if I said I'd do it? Flip the coin.
I have like a choose your own adventure notes here that I could switch based on your responses. It's very system
But
dynamic.
if I had said yes, would you flip a coin? And if I win, you'd give me $100?
Oh, we could do these if you want. We can, we'll have to meet up. All right. Here's scenario 1A, Tony.
No, we could do it right now. You could flip a coin.
Do you trust me?
Well, you'd have to flip it and catch it where I can see it and then show it to the camera. So nothing going on down here below. Your hands down here. No.
I have my kids doing the disclaimer at the end of the show. Do I have to add that we do not condone gambling here? I don't need the SEC
if
coming
we
down
actually
on me.
did that. Yeah, we couldn't do it on the show, I guess. So
all right. So same scenario. You win $101 or you lose 100, but we repeat it quickly 1,000 times through a computer algorithm. What would you do then?
I'd still say no.
You'd still say no. Okay, fair enough. A lot of people will say, I don't, it's not worth it to me for $1 to risk 100. Or, well, actually, they would risk 101. They would get 101 on a coin flip.
Right,
so theoretically, that's a favorable bet, right? You understand that this is a favorable bet.
It could go either way, though. It's really almost a 50-50 chance.
It is a 50-50.
So I've got a 50% chance of losing $100. So no.
Right. I get that. But what if you repeat it 1,000 times? You know that the expected outcome is you're going to make money.
So a computer algorithm repeats it 1,000 times. You're talking about the stock market now.
Oh, see, you're jumping ahead. I'm just so you still wouldn't take this bet, right? A lot of people
I'd rather
will take the bet over time. When they say it's going to be repeated 1,000 times, they say, "Oh, probability of me coming out ahead is high, so why wouldn't I?" Right?
Yeah.
But if you but you said let's just do it once, you wouldn't do it.
Right.
Most people will say, "I won't do it once, but I'll do it 1,000 times."
Yeah.
Doesn't make
I'm
sense.
even hesitant on the.
You are. I warned the viewers that you were a risk averse person.
Yeah,
So this is all right. Let's move on to the second scenario. Heads, you win $2. Tails, you lose $1. So if you're right, you get $2. If you're wrong,
I'd
you
do
lose.
that.
You would do that. You would take that bet?
Yep.
Definitely 100%.
Yeah.
Okay. Scenario
I
number
only
3.
lose $1, but I could win $2.
Right.
So.
2-to-1 odds on a 50-50 coin flip.
Yeah.
I think you'd be crazy not to take it, right?
Yeah. But why'd you go down to $1? I'd rather $200 I win, $201 I win.
Tony,
and
how about this? Heads, you win 20,000. Tails, you lose 10,000.
I can't afford to lose 10,000.
So think about this. Okay, you'd do it $2 to 1, but you wouldn't do 20,000 to 10.
Nope. Wouldn't.
Would you do $2 to 1 10,000 times?
I might. See what I did there? And the thing, my answers are, what's ironic about my answers is you'd say, would you do it if a computer algorithm did it 1,000 times back to back? Well, I do have money in the stock market, in my 401k and my IRA, as you know. So I am actually doing that, yet I'm saying I wouldn't. And I think that's a good point for your show. A lot of people who would be like me and say, no, I'd never do that. They probably have a 401k where they're doing it every day. Right? Am I right?
You are, and you're jumping ahead again. But think this through. So $2 to win, $1 to lose. You take that bet in a heartbeat. But 20,000 win, 10,000 lose. You don't, and it's the same exact, different. Really, it's just
ratio.
It's the same ratio. So why are you hesitating here?
Because the words "lose $10,000" are on the screen.
Right. So you have
and I'm like, I can't afford to lose $10,000.
Right. So this is risk aversion, right? So that, but it doesn't always work that way because you have to just factor in, like you'll jump on the $1, $2 because it's in your comfort level. But once you start getting with bigger numbers.
Yeah.
Okay. Here's another scenario, Tony. You win $1 million if you guess right, and you lose 100,000 if you're wrong. 10 to 1. On a coin flip, 50-50, 10 to 1.
That's tempting. Mortgage the house for that 100,000. I'm actually tempted on that one. I'm tempted.
All right. So 10-1 tempts you.
So we're gonna do this. You'd make this bet with me. You'll pay me $1 million if I win.
So
No.
yes or no? You do that. If this was, I mean, I'm not going to say you have to decide, but imagine this was a scenario. This isn't a slam dunk for you though. You'd have to really think about this.
Yeah.
You'd have to talk to your wife too. We talked about how we did a show on financial decision
Would
making and divorcing. Watch that, but
yeah. Yeah, she wouldn't let me do it, but I'd probably be tempted by $1 million.
all right, here you said you'd mortgage your house on it. I know you so well that I anticipated you would say that. So I'm going to ask the scenario 4 in a different way. And this is the last one, okay? So then we'll move on to scenario 4A. It heads, if you get it correct, you add $1 million to your home equity. If you get it wrong, you lose $100,000 in your home equity.
I'd do that in a heartbeat.
Why? How is that any different than $1 million cash and $100,000 cash?
Because I don't have $100,000 liquid that I would be willing to let go. But home equity is easier because it's there, and my bank accounts don't go down, and I can still keep making my payments and things like that. You know what I mean?
Would go up. You'd be paying more on that money, $100,000 in interest because of it.
True.
So
I would take that deal in a heartbeat, that home equity. Did you know I'd say that?
No, of course. You know, but is it, am I wrong in saying this is irrational to me?
No, I kind of get it. Yeah. I mean, home equity to me is, I don't personally, home equity is out there. I'm not using it right now, that kind of thing. $100,000 in cash. Where am I going to come up with that? It's not in my bank account. I don't want to cash out my savings or my investments, and that kind of thing worries me. But home equity isn't as, like, if to get $1 million,
So home equity is this nebulous thing. It's not right front and center. Same with the stock market, like you mentioned, 401k, people taking these risks over time. But what's interesting about retirement, I want to bring this to retirement, is that I mean, thanks for playing along. I'm not picking on you at all. I'm being serious
Of
here.
course you are.
I always pick on you, but no.
I love how you pick on me the whole show.
It's easy for me to say to somebody, oh yeah, why wouldn't you take the $1 million bet? It's 10-1, But then people immediately say, well, if you do it 1,000 times, I would take that bet, But you still could lose $1 million if you do it 1,000 times,
Yeah.
So it's a unique, and I don't want to get into the psychology of it. The show is, I want to talk more about how it relates to retirement, because you can make the case risk aversion has been analyzed and you could read studies on it, but a risk averse person, once the expected returns are concave in a little chart, that means that they're not going to take the bet. So you were close to that. You were textbook, like, hey, I'm not going to take that bet, and then do it 1,000 times. I'm still not going to take that bet. You're pretty solid on that. But once you start getting into home equity and you start to think, once you remove yourself a little bit from it. Okay. So let's talk about risk aversion in retirement. I want to talk just about insurance deductibles, because this is insurance is a risk mitigation. That's really what it is, right? So are you the type that likes to have copays that are going to be low?
Yep.
Or do you like to have a huge deductible that you have to meet?
Well, I like having copays. So, because I know that doctor's visit is worth $300, and if I'm only paying $30, I think that's awesome. Or $25 or $20 for a copay. I like copays. I don't like plans where you pay everything out of pocket up until a certain point, and that's one reason why I know everybody's big on HSAs. You're big on HSAs, but my problem with HSAs is I still have to pay the premiums every month, and there's still a ceiling that you have to hit before the insurance company will kick anything in, and then I'm responsible for everything up to that point. And the HSA money is my money. I put that, so I'm still paying premiums, and I'm putting my own money into the HSA, and I'm not getting those co-pays. So I'm paying $300 a doctor's visit.
I get it. That's why these plans exist and people lean to them, but I don't like them. Here's why. We did a show on dental insurance. I'll put that up there. Remember how I talked about how, people might be paying $50 a month for a dental plan and they're getting up to $1,500 or $1,500 of coverage, right? And so they just like the idea of having dental insurance because they like going and getting a free cleaning.
Yep.
I put that in air quotes, free cleaning or a reduced price for a filling or whatever it is, right? But in reality, when you think about it, you're paying $50 a month, which is $600 a year, whether or not you use it. Mm-hmm. And you're only going to get $1,500 of coverage. So you're really only getting $900 of insurance, if you think about it.
Sure.
So having a high deductible is a good way to ensure, and yes, you pay $300 to go to the doctor, but what if you save $300 a month in your price? People that are risk averse are willing to pay more now for coverage that really doesn't add up, right?
Right.
It's a unique thing. And a lot of people, when they're looking at Medicare supplements, Plan N versus Plan G, the main difference between these two, and people that aren't on Medicare or that aren't on supplements, they have no idea what I'm talking about. But those that do know exactly what I'm talking about. A Plan G covers everything that a Plan N does, except Plan N makes you pay a $20 copay to see the doctor. Okay, so you know that you're going to pay $20 every time you go to the doctor. What if it costs $30 a month less? Would you take it? Well, that depends. How many times am I going to go to the doctor? I don't know. Well, it's a gamble, right? It's a risk.
Yeah.
You would say, just give me, I'll pay the full price. I don't want to have a copay. I'd rather just, But if you do the math and say, well, I'm only going to go to the doctor 4 times a year, so I'm actually saving money if I go that way. But what if I don't? So again, that's an example of how risk aversion can affect people's retirement. Another example, Tony, is the stock market.
Yes.
So this is the biggie, right?
I jumped ahead to that earlier.
No, but it's where I'm going with this, right?
Yeah.
So people invest in the stock market, and when they retire, the big thing is, let's get bonds. Let me get fixed income. Let me put all my money in cash, money market, fixed annuities, CDs, bonds, right? That's safe. I don't want any more risk.
Safety, yeah.
But if you think about it rationally, why were you in stocks to begin with? If you know the outcome is going to be favorable, and how do you know the outcome is going to be favorable? Like this scenario. Heads, you win 20. Tails, you lose 10,000. If you're going to flip a coin every day for the rest of your life, you would take this bet. Well, you should, because in the long run, you're going to come out ahead. If you do this 10,000 times, you will win money. The risk of you losing is zero, because if you do it an infinite number of times, you're going to come out ahead, assuming the coin is 50-50. So with the stock market, if you look at history and say over a 20-year period, there is no 20-year period in the history where you lose money in the market. People still are like, no, I want it in bonds. Because they're focused on the short-term volatility. You are focused on that, I lose 10,000 right now. But if you spread it out and you say long-term, you should just let it go. You should take the bet. I'd smack you in the head and say, Tony, take that bet. But what would happen is, in your brain, you're saying, what if I lose that first one? What if I lose that first flip and I have to pay 10,000? I don't have it ready. I'm nervous. I don't want to lose. And that's what happens when people retire. What if the market tanks right away? Or I need this money to live. This is all I got. I don't want to run out. They don't think rationally about their expected return in the stock market. Why are we putting in bonds when the stock market's going to do better, right? I think any rational person would say, given a 20-year period, the stock's going to outperform the bonds, right? I think that's generally understood.
Right. But
So why?
what you're saying is dependent on time horizon then. Because if
Absolutely.
you have 20 years, that's one thing. But let's say you only have 4 or 5 years.
Yes. So risk aversion is useful, but you have to match with the time horizon.
Yeah.
So this is where, hey, you lose 500,000 if you lose, or you win 1,000,000. Well, that's a great bet, right? But
yeah,
if you're only going to do it once, you could see how people say, whoa, I don't have 500,000 to lose. If you're retiring and you only got 4 years where you're going to be spending this money, that's not what you put in the market. But what you do put in the market, what you do put at risk for the long term, why wouldn't you go all in stocks? Why would you own a bond if your time horizon is 10 years?
Well, I think because we always hear the traditional conventional wisdom, or the conventional line would be you need a balance of low risk and high risk, because low risk or no risk, because what if you need that money and you don't want it tied up in the market, and it happens to be a time when you need the money and the market's down. I think that's one. But your point about bonds, but what you're saying about bonds rings true right now, because bonds are horrible. I mean,
right.
Bonds have been horrible for a while now, and I mean, they aren't making any money.
But
very little.
A majority of people in this country own them.
Yep.
The question is why. And I think it's a risk aversion. So here's my thought to kind of,
because it's conventional wisdom.
Right. And I think people are looking at it the wrong way. What they should do first is say, what is my time horizon? Because if you said, well, the reason why people have bonds is because they might need that money in the short term. Well, if you might need that money in the short term, then your time horizon isn't long term.
Mm-hmm.
So you have to parse out the money you're going to need in the short term. And anything you're going to need in the long term, that's when you roll the dice. That's when you go big, right? And you just but people don't seem to do that. I think that's just the general point I want to say is risk aversion. When I asked you these questions, you answered how I knew you would, but a rational computer would say you're an idiot, right?
Right.
But I don't say you're an idiot because I feel the same way. Would I risk 100,000 to win 1,000,000? I don't have 100,000 sitting around. I would think long and hard about it. But if you asked a computer, they'd be like, well, before you finish the sentence.
Yeah.
They don't have these emotions. They don't have this risk aversion, and they don't have to worry about other things. And I think what people
to them, it's just math. Yeah. I mean, if you just look at the math.
Right. It makes sense if you just look at the math. You just take the bet. But life gets in the way.
But you're not telling people, Dan, to put everything at risk.
Absolutely not. What I'm saying is think about what your time horizon is, and if it's long term, let's just say 10 or more years.
Sure.
Why would you not go with risky assets in that? Why wouldn't you? And people usually have one bucket of 401k, say.
Sure.
And I'm 40 years old. I got 25 years before I'm retiring. I own 80% stocks and 20% bonds. What's the 20% bonds doing for you? It's standard practice, right? But the 20% bonds is reducing the volatility in the short term. In the short term, when you look at it every day.
If you're only 40, it is kind of crazy. You should have closer to 100% of your investments.
Theoretically, right? Then why don't we? Why don't most people? Risk averse or irrational? It seems irrational to me. I'd like to have the conversation with people.
Correct me if I'm wrong, but pressure's on you as a financial services professional. I think the between all the organizations that are out there that I don't want to use the word police, but oversee, and you're held to a standard and are licensed, and I think the pressure is to have not, you're not supposed to have all of your clients' money at risk. the pressure is for you to, okay, you got to have this amount in bonds. And I think that's just conventional wisdom. And I think, aren't you pressured as a financial services professional to put some of your clients' money in bonds?
Well, you think about it, the people that oversee me, the regulators, will look and say, how is it possible that the 70-year-old has 100% in the stock market? Well, yeah, that portfolio you're looking at, but we fail to realize, and this is the goal of the certified financial planner, is they have a pension, they have guaranteed income coming over here, they have
Social Security,
some assets in cash over here. Yes, their investment portfolio is 100% in because they're not planning to touch that for 10, 20 years. Yeah, they're only 70. They're already 70. 10 years seems like a long time, but they have their bases covered, so why not go for the home run? So I think people, generally speaking, feel like, oh, I have to have some bonds. I just have to.
Yeah.
Maybe not. Maybe that is irrational.
Yeah.
But I'm definitely, you're right. I'm not saying everyone should go all in, right?
Well, no, everybody's situation is different. We got to point that out. You're not recommending everyone do the same thing or go all in, because everybody's situation is different. Some people need that money they're going to need all the money they have invested to live on day to day. If somebody has, like you say, if they have a pension, from the government to the military, or a big, one of the big companies that still offered pensions, and they have Social Security and they have other income, then it's a different story. Right. But if, it all, and their time horizon,
their net worth.
Yeah. But maybe they want to leave all their investments to their family.
Right. What better way,
or save it for long-term, pull it out when they need long-term care.
Right.
At $12,000 a month.
Yeah, exactly. So, but if you had $1 million and you put it all in, what's risk-free? Closest thing we might have is treasury, inflation protected securities, right? TIPS. What are they giving? 1%. So you're going to get $10,000 of income off $1 million. It's inefficient. It's irrational. But hey, if someone wants to do it, so be it. But if you have your income set, if you have your safety net set, and if you have bonds, let's say you have bonds, okay, that's short term. Yeah. You need to then separate the long term and then go in. What I'm saying is, I think there's some irrational behavior here, but it's easily explained as we went through the scenarios. You're a completely rational person, but you can act irrationally when numbers get a little dicey. Well,
so to speak. Oh, I should have had it queued up. I should have had the crickets.
So I just wanted to point out to people, risk aversion is something that we all face. Some people are not risk averse at all when they should be, right? So, and they might have a gambling problem. But what happens is people need to reflect.
Gambling?
Oh, here we go. Yes. On that note, I know it's 21 and over only to gamble. I'm going to bring in my kids to end the show, Tony. Thanks for being a good sport and helping me through a risky scenarios that we went through.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Wendell nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.